Hello everyone, myself Shoaib Khan. I am come again to deliver my lecture on Unit 3 of Banking Law. Its title is Management of Deposit and Advances. Now, first of all, I give some a little bit introduction in it. Definition: what is deposits? Fund accepted by bank from customers, forming their primary liability. What is advances? Loans and credits extended to customers, forming the bank's primary assets. Now, what's the importance of it? Mobilizing deposit is crucial for funding advances and ensuring bank profitability. Proper management ensure financial stability and economic growth. Now, what are the type of deposit? Demand deposit, saving account. Current account, payable on demand without prior notice. Time deposit, fixed deposit, recurring deposit, withdrawal after a fixed period. Third is a specialized deposit, a tax saving deposit, NRI deposit. Now, what is the importance of deposit mobilization? It provides a stable source of fund for banks, support lending activities and economic development, enhances customer relationship and loyalty, and helps meet regulatory recruitment requirements like the cash reserve ratio CRR and statutory liquidity ratio SLR. What are the strategies of deposit mobilization? It's innovative products. It is an innovative product offering high interest rate for fixed deposit, introducing flexible saving schemes. It is a marketing efforts, advertisement and campaign outreach program in rural areas. Now, what about customer service? It's efficient and user-friendly service online and mobile banking. About the targeted scheme, senior citizen deposit scheme, youth and women center savings plans. And what the branch expansion? Opening branches in underbanked or rural areas. Now, what are the challenges in deposit mobilization? Increasing competition from NBFCs and fintech companies, low financial literacy in rural areas, and attracting long-term deposit in a volatile economic environments, and ensuring compliances with regulatory norms. Now we come to the conclusion. To conclude this topic, effective management of deposit and advances is crucial for banking operations. Deposit mobilization strengthens the financial base for lending, and innovative products, customer-centric strategies, and digital transformations are key to success. Thank you. Now our next topic of third unit is classification and nature of deposit account. First of all, I give a little short introduction in it. First of all, I give the definition. A deposit account is a bank account that allows customers to deposit and withdraw money while earning interest or fulfilling transactional needs. And purpose, what are its purpose? Its purpose is to save custody of money. Then third is earning interest, facilitating payment and the savings. And that what are types? Classified based on purpose, duration and customer needs. The next is broad classification of deposit account. It's classified into three types: demand deposit, time deposit and specialized deposit account. Demand deposit accounts, it's defined as deposit that can be withdrawn anytime without prior notice. What are its types? It's saving account for individual to save money and earn interest. Features is interest on balance limited withdrawal online banking. Second is current account for business and professional with high transaction needs. And its features: no interest, unlimited transaction, overdraft facilities. Now time deposit account. What is the time deposit account? Now that it is a deposit made for a fixed period and withdrawn after maturity. What are its types? It's most important and most known type in market is a fixed deposit, that is FD. A lump sum deposit for a fixed tenure or higher interest rates, early withdrawal penalty may apply. The second is RD, its full abbreviation is recurring deposit, regular monthly deposit over a fixed period suitable for discipline saving. Benefits of deposit account. For customers, save storage of money, earn interest on deposits, access to loans against deposit. For banks, stable source of fund for lending, help in fulfilling statutory requirements like CRR and SLR. Challenging in managing deposit account is low financial literacy in rural areas, competition from fintech and digital wallets, maintaining profitability in low interest rate environments, and ensuring compliances with regulatory norms. Thank you. The next topic of third unit is nature of banking investment. Introduction to banking investment. What is banking investment? Banking investment involve allocation of funds in various financial instruments to generate income, ensure liquidity, and maintain financial stability. What is core objectives? Is safety, liquidity, and profitability. Liquidity in banking investment. Definition. What is liquidity in banking investment? The ability of a bank to convert asset into cash to meet obligations. What are its importance? Ensures customers' withdrawals and payments. How it helps? It helps maintain financial stability. Liquid assets, cash reserve, short-term government securities, treasury bill. Balancing liquidity and profitability. Its conflict. High liquidity reduce profitability, example idle cash reserve. High profitability risk liquidity, example locked in long-term investment. What are the solution? Balance portfolio, mix of liquid and long-term high yield investments, and regular performance reviews and adjustments. What are the key challenges in managing liquidity and profitability? The first is regulatory requirements like CRR and SLR. The second is market volatility affecting asset prices. Third is balancing customer demands and investment returns. And fourth is economic uncertainties such as inflation and recession. Thank you. The next topic of Unit 3 is check, bills and their endorsement. Now, first of all, I explained that what is a check. A check, as we all know, that there are three types of negotiable instrument, that is check, bill of exchange, and promissory note. And what is check? Check is a written order by a bank account holder to pay a specified amount to the bearer or a named person. Now, what is bill of exchange? It is also a negotiable instrument which has been defined in section 5 of Negotiable Instrument Act 1881. Now, what is bill of exchange? It is a negotiable instrument directing one party to pay a specified sum to another at a future date. Now, what are the type of checks? A type of checks is bearer check, payable to the person holding it; order check, or payable to a specified person or order; cross check, payable only through a bank account; post dated check, dated for a future day; and stale check presented after its validity period, usually 3 months. Now, what are the types of bill of exchange? Demand bill, payable on demand; usance bill, payable after a specified time; trade bill, arising out of a trade transaction; and accommodation bill, drawn without an underlying trade. Endorsement of check and bills. The process of signing the back of a check or bill to transfer ownership or rights. Type of endorsement: blank endorsement, simply the signature makes it payable to the bearer. Special endorsement specifies the person to whom the instrument is payable. Third is restrictive endorsement, limit further in negotiation, example for deposits only. And fourth is conditional endorsement, subject to the fulfillment of a condition. Legal and regulatory aspects. Check law, governed by the Negotiable Instrument Act 1881. Provision for dishonor, validity and penalties. Bill of exchange laws, legal framework for acceptance, payment and disputes. And third is role of RBI, ensures compliance with banking norms. Challenging in handling check and bills. Fraudulent transaction, forgery or misuse of instruments, delayed clearance, affect liquidity and business. Third is dishonored check, impact on trust and relationships. Fourth is globalization, adapting to international check and bill standard. Now I finally conclude this topic. Banking investment must strike a balance between liquidity and profitability to ensure operational stability. Checks and bill of exchange play a pivotal role in facilitating trade and financial transactions. Proper understanding and management of endorsement are crucial for smooth banking operation. Thank you. The next topic of Unit 3 is government securities and procedure of e-banking. In it we discuss about I discuss about the exploring investment tools and modern banking operations. Now, introduction to government securities. What is government securities? First of all, I define the government security. The government securities are debt instruments issued by the government to borrow money from the public. What are its purpose? Its purpose is to finance and fiscal deficits, fund infrastructure and development projects. What are its features? It's risk-free, backed by the government, and fixed returns. Type of government securities. Now there are 5 types of government securities are there. First is short-term security, treasury bill, maturity of less than a year, 91 days, 182 days, and 364 days. Second is long-term securities, government bond, maturity ranging from 5 to 40 years. Third is state development loan, that is SDLS, issued by state government. Fourth is sovereign gold bond, that is SGBs, and bond backed by gold. Fifth is inflation index bond, IIBs, protects against inflation. Benefits of investing in government security. It's risk-free investment backed by the government. It's stable income, predictable interest payment. Third is diverse maturities, options ranging from short to long term. Fourth is market liquidity, easily tradable in the secondary market. And fifth is portfolio diversification, balanced riskier investment like equities. How to invest in government securities? There are four way in which we invest in government security. The first is through bank and brokers by purchase via authorized dealers. Second is retail direct scheme, RBI, directly buy and sell GSECs through RBI's online platform, user friendly for retail investors. Third is mutual funds and ETFs, indirect exposure to GSECs. And four is stock exchange, that is tradable in the secondary. Thank you. The next topic of Unit 3 is procedure of e-banking. Now what is e-banking? That is e-banking, that is electronic banking, allow customers to conduct financial transaction through digital platforms. Key feature is 24/7 accessibility, secure and convenient, wide range of services like fund transfer, bill payments, and account management. Now what are the types of banking services? There are e-banking services. There are 5 types of e-banking services, and they are as follows. The first is internet banking, which access account with via web browser. Second is mobile banking, transaction using mobile apps. Third is ATM services, that is cash withdrawals, balance inquiries. Fourth is phone banking, that is a transaction via phone calls. And last is e-wallet, in which digital wallets like Paytm, Google Pay. Now what are the benefits of e-banking? Its first and very important benefits of e-banking is that it is very convenient, means access anytime, anywhere. Second is efficiency, quick and real-time transactions. Third is cost effective, that is saves times and money on visits to branches. Fourth is enhanced security, encrypted and multi-factor authentication system. And fifth is wide range of services, that is it covers personal and corporate banking needs. Now what are the challenges which e-banking faces in our country and in the whole world? The first is cyber security threats, phishing and hacking fraud. Second is technical issues, downtime and connectivity problems. Third is digital divide, lack of access for rural and elderly population. And fourth is customer awareness, education users on safe e-banking practices. Now I conclude this topic. Is government security safe and stable investment option with accessible to both retail and institutional investment? E-banking a revolutionary shift in banking operation, offering convenience and efficiency. Require robust security measure to enhance trust and usability. Thank you. So this is the accomplishment of Unit 3. In next lecture, I deliver the lecture on Unit 4. Thank you.